Welcome to this YouTube channel. In this video we will talk about the global economic effects of the Ukraine war. So before starting this video, like this video and subscribe to our channel for future updates. Aside from the hardship and humanitarian disaster caused by Russia's invasion of Ukraine, the entire global economy will be affected by slower growth and higher inflation as a result of the attack. There will be three main pathways through which the effects will manifest themselves. Two factors will contribute to rising inflation. Higher prices for commodities such as food and energy will push inflation higher, diminishing the value of incomes and weighing on demand. Two, nearby economies, in particular, will be confronted with disruptions in commerce, supply networks, and remittances, as well as an unprecedented increase in refugee flows as a result of the Syrian conflict. The third factor is that lower company confidence and increased investor uncertainty will impact on asset values, tightening financial conditions and perhaps causing capital outflows from emerging markets to increase. Russia and Ukraine are important commodity producers, and the disruptions have caused global commodity prices to spike, particularly in the case of oil and natural gas, among other commodities. Food prices have risen, with wheat, which accounts for 30% of global exports and is produced primarily in Ukraine and Russia, reaching a record high. Countries with direct trade, tourist, and financial exposures will be subjected to extra pressures in addition to global spillovers. Increased oil imports would result in larger fiscal and trade deficits, as well as increased inflation pressure in oil-importing economies. However, certain exporters, such as those in the Middle East and Africa, may gain from higher oil prices. Greater danger of unrest in several countries, from sub-Saharan Africa and Latin America to the Caucasus and Central Asia, may result from higher food and fuel prices, while food insecurity is anticipated to worsen in parts of Africa and the Middle East as a result of higher food and fuel prices. It is difficult to predict the effects of these reverberations, but we already anticipate that our growth predictions will be revised downward next month when we publish our World Economic Outlook and regional assessments, which will provide a more complete picture. In the long run, the battle may radically change the global economic and geopolitical order if energy commerce shifts, supply chains rearrange, payment networks divide, and governments reassess their reserve currency holdings, as has been predicted by some analysts. Increased geopolitical tension increases the likelihood of economic fragmentation, particularly in the areas of commerce and technology. In Ukraine, the toll has already been enormous. Unprecedented sanctions against Russia will impede financial intermediation and commerce, resulting in an inevitable deepening of the country's economic crisis. The fall of the ruble is causing inflation, which is further lowering the living standards of the Russian people. Because Russia is a significant source of natural gas imports, energy is the most significant spillover channel for Europe. It is possible that wider supply chain disruptions will occur as a result. These ramifications will increase inflation while also delaying the recovery from the pandemic. Eastern Europe would be hit by growing finance expenses, as well as a swell of refugees. According to United Nations figures, it has taken in the vast majority of the 3 million refugees who recently fled Ukraine. European countries may also face fiscal challenges as a result of increased expenditure on energy security and defense budgets, among other things. While foreign exposures to Russian assets are minor by global standards, pressures on developing economies may increase if investors seek safe havens in the wake of the Russian asset price collapse. The majority of European banks have minor and manageable direct exposures to Russia in a similar manner. Beyond Europe, these surrounding countries will bear the brunt of the impacts of Russia's recession and the sanctions imposed on the country. Economic growth, inflation, and the external and fiscal accounts will all suffer as a result of reduced trade and payment system ties. Remittances, investment, and tourism will also suffer as a result of reduced links. While commodities exporters could gain from higher international prices, they also run the danger of seeing their energy exports limited if sanctions are extended to pipelines that pass via Russia. Increased food and energy costs, as well as tighter global financial conditions, are expected to have significant spillover impacts. Egypt, for example, buys approximately 80% of its wheat from Russia and Ukraine, according to the World Wheat Council. As a result of its popularity as a tourist destination for both, it will also suffer a decrease in visitor spending. Policies to curb inflation, such as increasing government subsidies, could put additional strain on the country's already fragile fiscal position. Furthermore, worsening external financial conditions may result in increased capital outflows and growth challenges for nations with high levels of debt and significant financing needs, particularly in emerging markets. In some nations, such as those with weak social safety nets, few job possibilities, limited fiscal headroom, and unpopular administrations, rising prices may exacerbate social tensions, causing social unrest. This catastrophe comes at a time when the continent was beginning to recover from the pandemic, and it threatens that progress. There are a number of countries in the region that are particularly vulnerable to the war's consequences, specifically because of increasing energy and food prices, as well as diminished tourism and the possibility of having problems accessing international capital markets. The conflict occurs at a time when most governments have only a limited amount of policy space to mitigate the effects of the shock. This is expected to exacerbate socioeconomic pressures, public debt vulnerability, and scarring from the pandemic, all of which were already affecting millions of households and companies at the time of the outbreak. For an area that imports approximately 85% of its supplies, with one-third of that supply coming from Russia or Ukraine, record wheat prices are particularly worrying. Food and energy costs are the primary channels via which spillovers will occur, and they will be significant in some circumstances. High commodity prices are expected to considerably accelerate inflation in Latin America and the Caribbean, which is already experiencing an average annual rate of 8% in 5 of the region's main economies: Brazil, Mexico, Chile, Colombia, and Peru, according to the World Bank. It is possible that central banks may have to defend their credibility in the fight against inflation even further. The growth consequences of high-priced commodities are variable. Higher oil prices damage importers in Central America and the Caribbean, but exporters of commodities such as oil, copper, iron ore, corn, wheat, and metals can charge higher prices for their products, reducing the impact on economic growth. Financial circumstances continue to be good, but escalating conflict has the potential to trigger global financial turmoil, which, combined with tighter domestic monetary policy, will weigh on economic development. Although the United States has few ties to Ukraine and Russia, which reduces the direct effects of the conflict, inflation was already at a 4-decade high before the war pushed commodities prices even higher. Once a result, as the Federal Reserve begins to raise interest rates, prices are likely to continue rising. The impact of Russian spillovers is likely to be minimal given the lack of direct economic linkages between the two countries, but slower development in Europe and the global economy would have a significant impact on key exporters. The most significant implications on current accounts will be seen in the petroleum importing economies of the Association of Southeast Asian Nations, ASEAN, India, and frontier economies, including certain Pacific Island countries. Because fiscal stimulus will support this year's 5.5% growth target, and because Russia purchases a relatively small quantity of China's exports, the immediate repercussions should be less severe for the country. Nonetheless, rising commodity costs and falling demand in major export markets exacerbate the situation. Shockwaves across the globe. The ramifications of Russia's assault on Ukraine have already shook not only those countries, but also the region and the rest of the world, underscoring the significance of a global safety net and regional agreements in place to protect economies from the effects of conflict. Managing Director of the International Monetary Fund Kristalina Georgieva recently told reporters during a briefing in Washington that the globe is becoming more shock-prone. While some of the consequences of the war and the resulting increase in the price of essential commodities may not be fully realized for many years, there are already clear signs that policymakers in some countries will find it more difficult to strike the delicate balance between containing inflation and assisting the economic recovery following the pandemic in the coming years. What do you think about this video? Do let us know down in the comments section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.